The 6 biases that wreck most portfolios and how to beat them. Most investors believe they're making logical, rational decisions with their money. But here's the truth. Your brain is wired to trick you, especially when money is on the line. Imagine this. The market crashes, headlines scream panic, and an investor sells everything at the bottom, only to watch prices recover days later. That's a classic example of a cognitive bias in action. From panic selling to chasing hype stocks at their peak, these hidden biases quietly control how we think about money, often leading to costly mistakes. That's why understanding cognitive biases is crucial for every investor. Today, we'll break down the most common investing biases, show real-world examples, and most importantly, how you can avoid falling into these traps. Anchoring bias happens when investors fixate on the first number they see, often the stock's highest price or their original purchase price. Imagine this. Last year, a stock hit $200. Today, it's trading at $120. An investor remembers that $200 and thinks, it must be a bargain now. Step by step, the investor buys more shares, convinced the stock will return to its old high. But they're anchored to the past, not the present reality. Here's the problem. The old price doesn't reflect the company's current value. Maybe the business lost market share or profits dropped. Now let's compare two companies. Company A was $200 but is now $120 after losing key customers. Company B is $120, but its sales and profits are growing. Anchoring bias tricks investors into thinking Company A is a better deal, just because it used to be more expensive. But Company B might actually be the smarter buy. The smart move? Ignore yesterday's price tag. Focus on current fundamentals, revenue, earnings, and growth potential. Confirmation bias is our tendency to seek out information that supports what we already believe, while ignoring anything that challenges our views. Imagine an investor who loves a particular stock. They read glowing articles and watch bullish YouTube videos but scroll past warnings or negative reports. When bad news finally hits, like a poor earnings report, they're caught off guard and may suffer unexpected losses. The best investors challenge their own assumptions. They actively look for information that disagrees with their beliefs. One practical tip: before making a decision, write down both the pros and cons, even if you don't like what you find. By facing uncomfortable facts, you'll make smarter, more balanced investment choices and avoid being blindsided. Imagine this. Losing $100 feels far more painful than the joy of gaining $100. Psychologists call this loss aversion. Our brains are hardwired to avoid losses at all costs, even if it means making irrational decisions. During the 2008 financial crisis, millions watched their portfolios plummet. Instead of selling, many investors froze, hoping their stocks would recover, even as companies went bankrupt. Loss aversion led people to hold on to failing stocks for years, refusing to accept a loss, only to see their investments become worthless. The solution? Set clear stop-loss rules before you invest. Write down the maximum loss you're willing to accept, and stick to it no matter what your emotions say. Sometimes, the smartest move is to cut your losses and reallocate your money to better opportunities. Remember, every dollar trapped in a losing investment is a dollar that could be working elsewhere. To beat loss aversion, focus on facts, not feelings. Review your investments regularly, and don't let fear dictate your decisions. Herd mentality is when investors follow the crowd, often without doing their own research. It's driven by the fear of missing out, FOMO, and the comfort of moving with the majority. Remember GameStop and AMC? In 2021, millions of people bought these stocks after seeing them trend on social media and news outlets. The hype drove prices sky high, but many latecomers lost money when the bubble burst. This isn't new. Herd mentality has fueled bubbles from the dot-com era to the housing market crash. When everyone's buying, it feels safe to jump in too, but following the crowd often means buying at the top, right before prices crash. Many investors panic and sell at a loss when the excitement fades. The best investors think independently. They do their own research, stay patient, and avoid getting swept up by hype or fear. Great investors often do the opposite of the herd, buying when others are fearful and selling when others are greedy. Markets reward patience, not FOMO. The takeaway? Don't let the crowd make decisions for you. Trust your research, set your own strategy, and remember, independent thinking is your edge. Overconfidence bias makes investors believe they're smarter than the market, often after a few lucky wins. Take Sarah, for example. After making several profitable trades, she felt unstoppable and started taking bigger risks. But when the market turned, Sarah's confidence led her to ignore warning signs, and she lost much of her gains. Data shows that most active traders underperform the market, mainly because of overconfidence in trading too often. The antidote? Stay humble. Accept that no one can predict markets perfectly. Stick to long-term strategies, diversify, and always keep your risk in check. Remember, true investing success comes from discipline, not overconfidence. Recency bias is the tendency to believe that recent events will continue into the future simply because they just happened. It's a mental shortcut that can lead investors astray. For example, after the 2020 market crash, many believed stocks would keep falling. But soon after, a historic bull run began, and some missed out because they were stuck in the recent past. The same happens in bull markets. When stocks rise for months, people assume the good times will last forever, often buying in right before a downturn. To avoid recency bias, zoom out. Study long-term charts, 10, 20, even 50 years, and notice how markets move in cycles, not straight lines. Remind yourself, short-term swings are normal. A long-term perspective helps you avoid emotional decisions and stay on track with your goals. Let's recap the 6 most common investing biases: anchoring, confirmation, loss aversion, herd mentality, overconfidence, and recency bias. Each one can quietly influence your decisions. To avoid these traps, use a checklist. Review your reasons for investing, seek out opposing viewpoints, set clear rules, and focus on long-term goals. Remember, the best investors recognize their own biases and design systems to minimize their impact. Take a moment to reflect on your own investing habits. If you found this helpful, share it with a friend and subscribe for more insights. Beating the market starts with beating your own brain.